51 global banks handed Anthony DeAngelis $180 million for salad oil that did not actually exist. Every single one of those institutions sent professional inspectors to verify the massive storage tanks, and every single inspector walked away completely fooled. Here is what nobody tells you about how that happened. This stands as one of the most audacious acts of corporate fraud in history. It operated exactly like a ghost factory. It functioned as a sophisticated Ponzi scheme hiding in plain sight. How does a single man convince the smartest financial minds to finance absolutely nothing? The answer is terrifyingly simple. Water floats. It really is that basic. DeAngelis knew that salad oil floats on top of water. He filled enormous metal vats almost entirely with seawater. He then pumped a few meager inches of real oil on top. When the inspectors dropped their metal dipsticks into the tanks, they measured the oil at the surface and calculated millions of dollars in inventory. They never checked the bottom. Common sense suggests someone would notice the missing product. A reasonable person would assume that a major institution would have foolproof auditing procedures. They did not. But the part that should make you stop is not the fraud. It is who approved it. The American Express Field Warehousing Division put their prestigious name on those warehouse receipts. They essentially guaranteed the existence of the ghost factory. A stamp of approval from a giant corporation creates a powerful illusion of safety. Investors inherently believe that internal checks and balances will protect their capital. That belief is often wrong. The auditors were ordinary people. They were easily manipulated by confidence and authority. DeAngelis would entertain them lavishly. He built a culture of camaraderie that made rigorous inspection feel like a personal insult. How often does social friction prevent people from asking the hard questions? The mechanics of the deception were incredibly rudimentary, yet flawless in execution. Some tanks were simply connected by a network of hidden underground pipes. The team would pump the exact same small batch of oil from one tank to another while the inspectors walked between the facilities. They were quite literally moving the shell while the bankers guessed where the pea was hidden. Nobody demanded to see all the tanks simultaneously. Nobody ran a basic chemical analysis on the depths of the vats. They saw exactly what they expected to see. The scale of the illusion grew so massive it threatened to destabilize the entire commodities market. DeAngelis used the fake inventory to secure more loans from prestigious firms like Lehman Brothers and Bank of America. He then used those new loans to buy real oil futures. He was attempting to corner the entire soybean oil market. By buying up the actual supply, he drove the price higher. This made his fake inventory appear even more valuable on paper. Why did nobody question the sheer volume of oil he claimed to possess? Because people want to believe in unbroken success. When the profits are flowing, skepticism completely disappears. The market was booming. The brokers were collecting massive commissions. The bankers were hitting their targets. Nobody wanted to be the person who turned off the money printer by asking a difficult question. This exact same dynamic appears in modern tech bubbles. It shows up in cryptocurrency collapses. The underlying asset does not matter when the chart is pointing up. The entire scheme relied on perpetual motion. It required the price of oil to constantly rise so DeAngelis could borrow more against his ghost factory to cover his previous debts. But markets do not rise forever. In November of 1963, a geopolitical shift triggered the collapse. The U.S. Senate stalled a massive wheat export deal with the Soviet Union. Prospects for agricultural exports dimmed, and the global price of soybean oil plummeted overnight. The banks immediately issued margin calls. They demanded cash to cover the sudden drop in the value of the collateral. DeAngelis did not have the cash. He only had tanks full of seawater. When the banks finally forced open the tanks to liquidate the assets, the truth evaporated the balance sheets of Wall Street. Two prominent brokerage firms went completely bankrupt. The New York Stock Exchange had to halt trading. The shockwave forced American Express to cover the losses to save its own reputation. A company known for financial security was nearly destroyed by salad oil. There are three critical lessons from the Allied crude collapse. The first is the verification trap. People assume that because a process involves paperwork and professionals, it is inherently rigorous. They mistake the appearance of diligence for actual diligence. The bankers held beautifully printed warehouse receipts stamped by American Express. They treated those pieces of paper as if they were physical barrels of oil. This same error happens during contract reviews and quarterly audits. Scanning, formatting, and signatures creates a false sense of security, assuming the substance has been vetted by someone else. The base reality must always be verified. When buying a business, reading the revenue spreadsheets is never enough. Calls must be made to the customers. The inventory must be physically checked. Never accept a proxy for the truth. The second lesson is the complexity shield. Financial crimes often hide behind layers of mundane bureaucracy. DeAngelis used the obscure mechanics of commodities trading to baffle outsiders. He created an environment where asking basic questions made outsiders look incompetent. When something seems too complex to understand, the natural tendency is to defer to the experts. Capital is handed over to avoid looking stupid. This is a fatal mistake in business. If an investment strategy or a corporate structure cannot be explained in one simple sentence, it is hiding something. It might not be a Ponzi scheme, but it is certainly designed to obscure risk. The complexity is the weapon. It can only be disarmed by demanding simplicity. The third lesson is the danger of shared assumptions. 51 different global banks financed this ghost factory. Not a single one of them performed an independent root cause audit. Why? Because they all assumed the other 50 banks had already done it. This is the exact herd mentality that drives every major market crash in human history. Respected institutions throw money at a new trend, creating a mirage of safety. Onlookers assume the experts know something secret. In reality, they are looking at everyone else, assuming the exact same thing. Everyone is relying on everyone else's supposed due diligence. The entire system is built on a circular foundation of blind trust. Business decisions cannot rely on the diligence of others. Capital is only safe when its destination is completely understood. When investing in a company, trace the actual path of the money. Does it buy physical assets that can be touched? Does it fund operations that can be observed? The moment an investment becomes an abstraction on a ledger, vulnerability skyrockets. The polished presentations must be ignored. The prestigious logos of the auditing firms mean nothing without verification. The dumb questions must be asked. Ask them until the answer makes logical sense. If that answer is missing, walk away immediately. It does not matter how much money is on the table. It does not matter if 51 global banks are already involved. They are just as capable of being fooled as anyone else. The story of Anthony DeAngelis is not just a historical curiosity, it is a blueprint of human vulnerability. It exposes the fragile foundation of trust that supports the entire global economy. Every time a financial agreement is signed, someone is stepping onto that foundation. They are trusting that the ink on the page corresponds to something real in the physical world. Most of the time, it does, but when it does not, the resulting destruction is absolute. The bankers who walked through that New Jersey facility saw exactly what they were conditioned to see. They saw towering metal tanks. They felt the cold steel. They looked at the clipboard in their hands and matched the numbers. They never stopped to consider that the tank was full of the ocean. Make sure you know what is actually inside the tank. 51 global banks handed Anthony DeAngelis $180 million for salad oil that did not actually exist, and they did it because they forgot to check if the tank was full of water. This is the story of Anthony DeAngelis, and I just hope you learned something valuable from this case study. That's all from our side today. If you learned something valuable, please make sure to hit that like button to support our work, and for more business case study, please subscribe to our channel. Thank you so much for watching. I will see you on next one. Bye-bye.